Welcome to our channel Cashflow Vision. Today, we will discuss debt to equity ratio. Growing a business requires inflow of capital. When companies are growing, they need money to launch products, hire employees, and expand their operations. There are many ways to raise funds, and each will have a different impact on a company and the pace at which it expands. The most common way to raise capital is through either equity or debt. But what do each of these entail? The debt to equity ratio shows how capital has been raised to run a business. It is considered as an important financial metric because it indicates the stability of a company and its ability to raise additional capital to grow. It is important to note the debt to equity ratio will vary across industries. This is because different types of businesses require different levels of debt and capital to operate. The debt to equity ratio is used to indicate how risky it is to invest in a company. The higher the debt to equity ratio, the riskier the investment. Guys, debt is an amount owed for the funds borrowed from a lender. The lender agrees to lend funds to the borrower upon a promise by the borrower to pay back the money as well as the interest on a debt. The interest is usually paid at regular intervals. A business acquires debt in order to use the funds for operating needs, whereas equity is stock or share representing an ownership interest in a company. It is investors' ownership in an asset, like company's property, equipment, car, etc., after your debt on that asset is paid. When a business uses equity financing, it sells shares of the company to investors in return for capital. Guys, let's take one example. Let's say we have a company and applying for funds and needs to calculate debt to equity ratio. Its total liabilities are $300,000 and shareholders' equity is almost $250,000. If we input these figures in a formula, debt to equity, my answer will be 1.2. That is 300,000 divided by 250,000. With a debt equity ratio of 1.2, investing in less risky for the lenders because the business isn't highly leveraged or primarily financed with debt. So guys, before investing, we need to understand what DE states. I hope you will find this video helpful. Take care, stay safe.